Uh, Rohith sir, Yagnesh sir, we are ready to go live. Okay. Uh, and 10 count, will go live. Good evening, everyone. Welcome to the 147 knowledge series of ANMI. Today, we come up with a webinar in the topic of navigating the online fixed income space. Today, we have with us Mr. Rohith Loka Reddy, Director, National Council, ANMI, and Mr. Yagnesh Upadhyay, Director, Strategy and Growth, Techwealth Capital Services, Private Limited. I just take a few minutes to introduce Mr. Rohith Loka Reddy, who's the Director of National Council, ANMI as well. To introduce Mr. Loka Reddy, a distinguished professional with a dynamic career in finance, Mr. Rohith began his journey at the prestigious Manulife Global Strategy Income Team, where he played a pivotal role in managing an impressive $20 billion USD portfolio in 2014. After earning his degree from the Indian School of Business, he joined his family stockbroking firm, Northeast Broking Services Limited, demonstrating his entrepreneurial spirit. Mr. Rohith also founded S Finance, an NBFC that has grown steadily under his leadership. More recently, Mr. Rohith has made his mark in the field of distressed investing, with his latest achievement being the acquisition of Viceroy Hotels. In addition to these achievements, he serves as a director in the Association of National Exchanges Members of India, that's ANMI, contributing to the broader financial community. His expertise is further solidified by his qualification as both a CFA charter holder and a financial risk manager. Welcome to the webinar, Mr. Rohith Loka Reddy. We also have with us today, the speaker of the evening is Mr. Yagnesh Upadhyay, Director Strategy and Growth, Techwealth Capital Services Private Limited. Mr. Yagnesh has 2 decades of experience in fixed income markets. He has handled wide arrays of jobs, namely fixed income, product development, setup of online platform for fixed income market, strategy consultancy and business development. He was a part of Bombay Stock Exchange and successfully led various initiatives like bond market reporting and settlement platform. He also played instrumental role in developing electronic book building platform, that is EBP, FPI bidding platform, and IRF platform. We welcome to the webinar, sir. Over to you, Reddy, sir.
Thank you, Stephen, for the introduction. I would just like to thank everyone for joining this session. And it's great to see good attendance for this session. And we are very excited to start this session on fixed income and how technology is transforming the space. Today, we're glad to have Mr. Yagnesh as a speaker with us. He heads the strategy and growth at Tipson, and he would be shedding some light on this topic. He brings deep insights into a market and I'm sure we leave with a fresh perspective on the opportunities available. I would just like to say fixed income investing has traditionally been very complex and difficult to access. It's been more OTC and more by calling the brokerage and a more closed market. But with all the digital platforms coming in, more investors are beginning to explore this space. The ticket size is also becoming smaller, especially with the new SEBI initiatives. So I thought, given that the space is so competitive with just a plain vanilla brokerage, adding new offerings is the only way to grow and thrive into this hyper-competitive market. And I'm sure today we learn from Mr. Yagnesh the opportunities available and how stockbrokers can take advantage of this and work with organizations like Tipson and other fixed income players. Over to you, Mr. Yagnesh.
Yeah, thank you, Lokesh. Thank you, ANMI team, to give us the opportunity, to speak about the fixed income market. I'll quickly give you a background about the company. We've been part of the fixed income market for over 30 years. We started our journey in 1993. So we carry 30 years of experience with us. And we are one of the largest bond house of India. And we are also category 1 merchant banker. So any issuer want to raise money through bond in India, we act as a arranger cum underwriter for them. And then we run the prop book and then we do the distribution. So our large participation is, Rohith mentioned it was largely institutional market. So our background was largely on the institutional side. Since last 5 years, the market has opened up a big time for the retail investor, where retail individual investor, HNI, NRIs, and corporates are participating heavily. And then the market has developed multifold on the retail non-institutional segment, where now we play the major role. We also run the online platform because this is the digital era. So we also run a fintech platform, which is our fintech fixincome.com, where retail client can come online and invest in bond online. So as Rohith mentioned, that the investing in the bond was a tough task. It was not easy for a broker or individual to participate in the bond market. But now with the regulation, with the proactiveness of the regulators, the market has opened up a big for the broker and the retail participants. You guys know about the bond market, but still I'll quickly give you a background of the market. Why any entity tap the bond market? Because any entity want to raise money, there are only two options. Either they raise money through equity, where they have to dilute their ownership, or second, they borrow from the market. Now, traditionally, most of the entity were heavily depending on the bank and NBFC for their borrowing. And now, when the market has opened up, these entities are tapping the capital market, which is they're borrowing through bond. And large dependency of this NBFC, and in the growing sector on the manufacturing side, they have started borrowing heavily through the bond. So they raise money through issuance of the bond. Now, if we talk about the instruments on the bond, there are largely two categories of the instrument. One is the government bond and one is the corporate bond. Government bond is a bit important for you guys because you all are into broking industries. So government bond will not only help you with the investment option, it is a fantastic tool, to increase your existing trading activities, because bonds, you have to have a 50% cash collateral with the exchange, to get the margin and all. And this GSEC falls under this 50% cash collateral category. So you can have a GSEC as an investment tool for your client. Your client can place those GSEC as a margin, as a collateral to the exchange to get the margin. Within GSEC, there are three categories of the instruments. The first is the central government, where central government issue a government bond. It is called the central government securities. It's sovereign security, the only risk-free asset of India. The second, when the state issue the bond, when for state borrowing requirement, they issue a sovereign bond, which is called SDL, State Development Loans. And the third is to meet the working capital requirement of the government, they issue a treasury bills, which is a money market instrument. So within treasury bills, there are three maturity which government issues through RBI, which is a 91-day T-bill, 182-day T-bill, and 364-day T-bill. These three instruments that is. T-bill and the central government securities both are eligible to place as a collateral with the exchange, and you get the margin. The good part is here, the haircut applicable on GSEC ranges between 2 to 5% only. So for example, if you invest 1 CR in the government securities, you get the trading limit or margin with anything between 95 lakhs to 98 lakhs. And then you can use that money to your trading strategy and maximize the return of the client. That is one. The second part, where the maximum retail investment is happening, is the corporate bond. Where you have bonds starting from AAA rated bond, like bond issued by the PSUs like PFC, REC, SBI, and then you can have a bond up to the investment grade, which is a BBB plus. And then the yield range, return range between anything between 7.5% up to 13 to 14%, depending on the rating of the bond, you have instrument available. So bonds issuer are largely classified into PSU bonds, which is issued by the PSUs, a bank bond, largely issued by the banks. You have a largest borrower sector, which is the NBFC, because for NBFC, the money is their raw material. So one of the largest borrower category of the bond market is the NBFC. You will have NBFC like Shriram Transport, Cholamandalam, Tata Capital, L&T Finance. This type of issuers are there. Then you have municipal bond. Recently, all municipal corporation, all major municipal corporation has started tapping the bond market. So to meet their city's expense requirement, they are borrowing money through the bond market. And the most, I would say, liquid or preferred option for the retail investor is the government guaranteed bond, which is issued by either state or central PSU, where state or central government has given the guarantee for interest and principal repayment. So these are largely on the instrument side. If I talk about, which the equity market is big, but I just give you a brief on the volume with the bond market generate. So, daily volume of GSEC market is anything ranging between 50 to 60,000 crore. And the daily volume of corporate bond, which is around 6 to 7,000 crore. So if you see annually volume combined of GSEC and bond, the corporate bond is more than 100 lakh crore, which is much, much larger market than the equity and equity derivatives market. As far as the participation in the bond are concerned, there are again two ways. You can participate in primary or in the secondary market. Primary, again, there are two options. You have like equity, you are well versed with the IPO. Bond comes with the IPO also. It works similarly the way equity IPO works. You can participate in any current NCD issuances like you participate in equity. You don't have to have a separate infrastructure for that. And the second, largely bond are issued through a private placement, where you have to participate through a bond house like us. Whenever any bank or any PSU or any government guaranteed bond comes out with the bond issuances, you can participate through a bond house like us in the private placement. In the secondary market, up till now, secondary market is phone market, OTC market, where trade executed over the phone or verbal or email, and with the settlement, clearing and settlement happen through the exchange like NSEIL. There is a evolvement in the market. There is a new regulation which has come into market recently, which is OBEP, where majority of the trades are now happening through the RFQ, which is a request for quote, a semi-trading platform where one party put the quote, second party accept, and then the trade get executed. I'll quickly share you the number. RFQ was introduced a couple of years back. It was largely introduced for the institution, and now all the broker and retail investors are also using this RFQ platform. If I give you August month data of NSE, 83,000 crore worth bond were reported and settled on NSE platform. Out of this 83,000 crore, 41,000 crore were executed through the RFQ platform. So RFQ is now accounted for the 50% of the total market on the bond side. Bond taxation, there are recently change in the taxation and the bond. So that's why I'm covering this point. Bond taxation is very simple. Below 12 year, it's like equity. Below 12 year is short-term capital gain, and 12 year above is a long-term capital gain. Your short-term capital gain is taxed as per your slab rate, and long-term capital gain is 12.5%. And the interest income, because bond carries the coupon, the interest income which you earn on the bond, it is taxed as per your slab rate. The only exception is there are zero coupon bond which are notified by the gadget notification. There you have because there is no interest, so there you have a long-term capital gain benefit. You would have heard in the news that REC is going to tap the bond market with the zero coupon deep discount bond soon. It will be a 5,000 crore issue where you will get the long-term capital gain benefit. So for example, if you buy a bond at say 50 rupees and it matures at 100, the 50 rupees different, you just have to pay the long-term capital gain, provided you hold it for more than 12 months. Quickly on the benefit of the bond market, you all know the bond provide you a perfect diversification. One of the safest asset class among the all investment category. The bond is the only asset class, where your return is predictable. So if you invest in, say, SBI bond at 8.5%, till the maturity, you're going to get 8.5%. Even if the Nifty Sensex become 1 lakh or even become 10,000, your income is predictable and there is no volatility impact on that. The bond labels are defined based on the credit. So AAA would be spread over the GSEC, and then as far as the rating goes down, the spread over the GSEC is added. The risk associated with the bond, there are three risks which is predominantly associated with the bond. The biggest risk is the credit. What if the bond you invest and the company go for the bust? So then whenever you invest in the bond, your rating become the most important criteria. That based on that, you assess the preliminary risk of the bond. The second risk associated with the bond is the liquidity. We know the bond market volume are huge, but it is not concentrated on any particular ISIN. So the liquidity is still a constant. You might end up holding the bond till the maturity of the bond. And the third is the interest rate risk. Interest rate risk is applicable only when you are trading in the bond. If you are investor, if you are holding till maturity, then interest rate risk does not arise to you. But when you are trader, then based on the interest rate cycle, you might end up making a capital gain or capital loss. You know your client, you know who all can participate, but quickly give you a list that all individuals can participate in bond, NRI can participate in bond, your mid-size, large-size corporate can participate in bond, all the trust, including your provident fund, PF trust, your religious trust, educational trust, can participate in bond, they can invest in bond. Housing society, as long as they have a demat account, they can invest in bond. Chit fund, as long as they have a demat account, they can invest in bond. All institution, of course, they are predominantly investing in bond, but you have institutional client, they can invest in bond heavily. FPIs can invest in bond without any restrictions. Your venture funds and all invest in bonds. So this is just to give you, these are the all category of investor who can invest in equity market or derivatives, they can invest in the bond. And there are a few more categories of investor who can invest only in the bond. Yeah, like your provident fund client, they will not invest in equity. Your religious trust will not invest in equity, but you can have those clients to invest in bond. And lastly, because when you expose to the bond market, few factors you'll have to consider to invest in the bond. First is to analyze the credit of the bond, the rating. AAA is the one of the safest rating, the top-notch rating, and the investment grade goes up to BBB plus. So rating is your first parameter. The second, issuer background, the issuer where you are investing, what is their current market position, what could be their future for after 5 years, how the cash flows look like, how their asset liability management they are managing. All these factors you will have to consider before investing in bond. The third is the tenure of the bond, for how long you are investing in the bond. When you invest in an A- rated paper, you would not be investing for more than a 2 years or 3 years span, because you don't know the rating of because of the lower rating, how much risk on the tenure you want to take. So you will be restricting your investment to a short-term paper. When you invest in AAA PSU like PFC, REC, SBI, you can invest for a longer horizon also. So the tenure of the bond is important. The return expectation is important factor. What is the return expectation of your client? So your client is return expectation is only 7% to beat the FD. You can give them the GSEC without taking any risk. If your client expectation is to 12 to 14%, then you can invest, have them the option to invest in A or A minus rated bond. And then the most important part is the profile of your client. So if your client is senior citizen, you will be offering him the one of the safest asset class with the GSEC. Your client is a risk-taking client, then you can have a BBB plus rated bond, which can give 14-15% also. So depending what is your client profile, you can offer the bond. And last, before I hand it over to Rohith, there are few recent development, to open up the market in a big way to retail investor and to the broker network is one. The face value of bond used to be 10 lakh, which was brought down to a 1 lakh. So one can invest in 1 lakh multiple. Now in last month, it was further reduced to 10,000. So now actually one can invest in a 10,000 multiple. So this could be a perfect substitute for the FD investment. A client who is doing FD with the bank when we don't have a role to play, you can give them the option to invest in the bond. That is one part. There, like for mutual fund and equity, you have a distribution code, like you have a licenses and you have distribution code. So very soon there'll be a code for the distributor to distribute the bond in the market, which is FISD code. Very soon it will be introduced in the market. And the last is in the recent, which I mentioned that recently, SEBI to develop this market on the retail front, they have introduced the OBBB regulation. Any stockbroker want to distribute bond through their existing channel or through their online platform, they can offer the OBP license and they can start distributing bond online. They can tie up with the platform like us, who can lend the technology, and then you can have your platform, and through online platform, you can service your existing client with the bond, or you can onboard new client with the bond. So that's brief on the bond market. Rohit, now if we have any question, we can take on the question.
Thank you very much, Yagnesh, sir. We have received 3 questions, or one which I'll read out to you now. One is, how can one participate in money market mutual funds, and brief overview of returns?
Um, Sivanji, this is for largely for the fixed income. So money market mutual fund will definitely fall under mutual fund, but you want to invest in the money market instrument. So in the money market also there are two bifurcation. One, the money market instrument issued by the government, which is the T-bills, treasury bills, and the second is money market instrument issued by the corporate, which are the CPs. So you can participate in both. T-bills, you can participate in through auction every Wednesday of the week, every week, there is a T-bill auction, which you can participate through NSE e-bill platform. So that is one thing. Secondary market also you can participate. You have any specific tenure requirement, you can get in touch with any bond house and they can provide you quote for that market. You will be holding this T-bills in your existing demat account. You don't have to open a new demat account to hold this T-bill. And the second is CP, which is the commercial paper, which is largely a on-tap market on the primary issuances. Whenever you have a requirement, you can go to the issuer like, say, Adani, L&T, Tata, they keep on raising money through the CP. CPs are basically commercial paper, which are a money market instrument, below 1 year instrument. And these are on-tap. You can reach out to any bond house. They will help you to invest in the CP of any of the market investors.
Thank you, sir. The second question which we have received from a member is brief view on treasury bills and the process.
Yeah, so treasury bills, I just explained. T-bills are treasury bills which are issued by the central government. In T-bills, there are three types of instrument they issue. Basically are three tenures. One is 91 days, one is 182 days, and one is 364 days. T-bills, see the government securities are the primary investor of large participant in the government securities are the banks. So whenever government, RBI through government issue T-bills, so they have a two type of mechanism. They call it a competitive bidding and non-competitive bidding. Competitive bidding is largely for the institutional client like bank and mutual fund, when 90%, 95% of the issuance are subscribed through competitive bidding. 5% portion, which is kept for the retail, they call it non-competitive bidding. You can participate in this non-competitive bidding through NSE platform, NSE Go Bid platform, and you can use your existing demat account. Excuse me. And it is like a primary subscription. Every Wednesday there is a code. You bid for the quantum, that how much amount you want to invest based on the cutoff in the competitive market, which is 95%. Same cutoff will be applicable to you. You will be getting allocation based on that, and then unit will be credited in your demat account. The money market instrument, because these are below 1 year instrument, they does not carry a coupon. These instruments are issued at a discount, say 100 year, and on the maturity you get the face value back. So for example, face value of T-bill will be 100 rupees. It will be issued at say 97, 96 or 90 rupees. At the maturity, you will get your 100 rupees back. So your return is the discount which you get at the time of the investment.
Right, sir. We have the last question for the evening. That is post-tax returns comparison with competing products.
Recently there is a change in the tax structure of the bonds. The bonds are now taxed, as I mentioned, the long-term capital gain is now taxed at 12.5%, and the short-term is as per the slab rate, which is same in the all other asset classes. Earlier, mutual fund, debt fund used to enjoy the tax benefit. They had indexation benefit also, which is now gone. It is all equal now. You invest in the bond or underlying debt fund, there is no taxation arbitrage. So as far as the post-tax is concerned, depending on what return you are getting, your post-tax will be calculated. But the tax slab for all other asset class are same. Long-term is 12.5% in the bond, and your short-term is as per the slab rate. And interest, of course, is as per the interest what you earn on the bond, it is as per the slab rate.
So just a follow-up on the taxation question.
Yeah.
On the corporates can issue zero coupon bonds and enjoy long-term tax rate, right? That's
no, Rohit. So only notified bond, which are notified through a gazette, they get the long-term capital gain benefit. All other zero coupon bond, if you, so I'll give you two examples. One is the zero coupon bond issued by a corporate, which is non-notified corporate. So if you invest in the zero coupon bond at 50 rupees and after 5 years, you're going to get 100 rupees. So this 50 rupees difference, you will have to, accrue on an annual basis. So every year you will have to accrue 10 rupees as an interest and you will have to pay tax on that. You don't have a long-term capital gain benefit on that. On the other side, when you have a notified bond, which is issued by only two issuers as of now, REC and the NABARD, this notified bond, if you invest at say 50 rupees, same example, on maturity, you're going to get 100 rupees. On 50 rupees difference, you will have to pay a tax long-term capital gain of 12.5%. So you have clear benefit on this notified. All other zero coupon bond, you will have to accrue the interest on the annual basis. You have to pay tax on that.
So basically, you'll have to pay your interest, same tax as you pay interest or FDs or anything else.
Yes, absolutely right.
And just one more question I want to ask. I think the biggest issue I think most brokers would face is that when they get a client into a bond, they also need to give them an exit. I mean, the RFQ platform was supposed to solve some of that, but it has not. Is there any other ways or processes that's happening? I know SEBI has come up with the paper that the issuer itself can buy back. But what is the process today and what can be done?
So RFQ platform, as I mentioned, it is just introduced 2 years back. So it's very nation stage. It will take some time to platform to mature. Then you will have the exit on the platform. As of now, as I mentioned, there are no exit on the platform. To exit, you'll have to get in touch with a bond house like us, where we have a prop book, also support of the prop book. So we can give them the exit on whichever market level, current market level, we can give them the exit. The second, now the market is opening up in a big way, so we can use the network of the market and we can, float the offer to the market. The beauty of the RFQ platform, any client want to sell, I can showcase the paper to the entire market and someone from the market will get interested. We can get in on one-on-one touch and then get the exit. But first, liquidity would be provided by us, people like us, and we give them the exit option.
And there's no settlement risk in RFQ, right?
No. So bond, though it is OTC market traded on the phone, but the settlement happens through the clearing corporation. So the clearing corporation act as a central counterparty. So in a simple example, if I tell that I am the seller and you are the buyer, if you transfer the fund to clearing corporation, and in worst case I fail to transfer the security to clearing corporation, you are sure that you will get your money back in your account on the same day. So there is no counterparty risk on the bond. Bond is not on the DVP3 like equity. This is not guaranteed settlement, but only the settlement is facilitated through clearing corporation, so you don't have a counterparty risk.
I think it's very helpful. Again, a lot of people are looking at this space, and given how competitive the rest of the market is, there's definitely a lot of opportunity. I'm sure over the next few years, people will enter it and see how great the opportunity is.
Yeah. So, Rohith, what we see, what is happening in the mutual fund, whoever entered the mutual fund early 2000, as an early entrant, they get the maximum benefit. We see next 5 years is largely for the fixed income market. It will be open up in a big way for the retail investor, and that's why there are regulation coming in. So this would be actually right time, and GSEC would be the first step. Where you can use that investment to increase your trading activity also. And you get, well versed with the bond market modalities, also how the fixed income market works. And then you can move to the corporate bond also, which will be a pure investment tool for the client. But mark my word, next 5 years, this market would be one of the biggest retail market in India after equity and mutual fund.
We have to wait for an equity market crash for this to grow, right?
True.
So I think most of the questions have been answered for this evening. Rohith sir, I would request you to please give a vote of thanks.
Thank you, sir, for actually walking us through the space, helping us understand it. It was really helpful. I think it's not a space that's well discovered yet, and I'm sure over time it will get more and more well discovered. And thank you for taking your valuable time and actually spending it with us this evening. And all the members would have benefited greatly from this. So I'd just like to extend the thanks from ANMI and from myself personally for doing this session with us.
Thank you, Reggie. Pleasure is our, that we would like to do a more such session. We'll also share you, brief presentation on the whatever we have on the market, that how the market functions, and we'd love to, host more sessions on the bond market.
Perfect. We'll keep that in mind, sir. I'm sure we will do a few more collaborations in the year ahead as well.
Thank you, Stephenji. Thank you for giving us this
Yes, sir. Thank you, Yagnesh, sir. Thank you, Mr. Rohith. And I thank all the members who had connected with us this evening through our YouTube channel. And surely we'll be coming up with more webinars on the ANMI platform. Thank you, everyone.
Thank you.